Hey traders, Gavin McMaster here from Options Trading IQ, and today you're going to learn how to understand option delta. Just before we do, a quick reminder that everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. So delta is one of the four main option Greeks, and any serious trader needs to have a thorough understanding of this Greek if they hope to have any chance of success in trading options. Delta dollars can be used to tell the overall directional exposure in the market. So we're going to take a look at what delta dollars is and how to use that. But first, what is delta? Well, delta is the option sensitivity to changes in the underlying stock price. It measures the expected price change of the option given a $1 change in the underlying. So call options have a delta between 0 and 1, and put options have a delta between 0 and -1. Call option delta. So if we assume a call option has a delta of 0.50, this indicates that for every $1 move in the underlying stock, the option price will change by 50 cents. So here we've got two different options. On Apple, the 190 call has a delta of 49. So for every dollar that Apple rises, that option will change by 49 cents. The 200 call is further out of the money and has a delta of 22. So for every dollar that Apple rises, that option will rise by 22 cents. Using an example of XYZ stock trading at $50, a 6-month $50 call option is trading at $4.50 and has a delta of 0.50. We say 50 delta for short. The next day, if XYZ rises to 51, so a price rise of $1, the price of the option will have risen to $5, so a rise of 50 cents. Note that this example ignores any changes due to vega, gamma, and theta, which are the other main option Greeks. So put options always have negative delta. If XYZ is trading at $50 and a 6-month $50 put option is trading at $5 with a delta of negative 0.50, a $1 move up in the stock price, we'll see the $50 put decline by $4.50. So let's look at a couple of other examples here with Apple again. That $180 put, quite far out of the money, that has a 18-19 delta. So if Apple goes up by $1, it's going to lose 19 cents. And if Apple goes down by $1, the put option will gain 19 cents. Similar with the 190 put, it's close to the money. It's got a 44 delta. If Apple goes down by $1, it's going to gain 44 cents, the price of that option. An important concept to understand is that as expiration approaches, the delta of out-of-the-money options will rapidly approach 0. Less time to expiry means less chance those out-of-the-money options will end up in the money. Therefore, they have a lower delta. You can see that here in this diagram. Let's look at the delta and gamma relationship. Gamma measures how much the delta will change given a $1 move in the underlying. If delta is the speed at which option prices change, you can think of gamma as the acceleration. An option with a gamma of plus 0.5 will see its delta increase by 0.5 for every $1 move in the underlying. So the gamma is measuring how much our delta will change, and delta is measuring how much the price of the actual option will change. What about volatility? So how does volatility affect an option delta? Volatility is a crucial factor in options pricing and has a significant impact on an options delta. An underlying stock trading at $50 with a 6-month $60 strike call is much more likely to expire in the money if the implied volatility is high, as traders are expecting a big move in the stock. Conversely, if implied volatility is low, using the same example above, then it's less likely to expire in the money, as traders are not expecting a big move in the underlying. Therefore, if there's lower volatility, further out of the money options have a lower delta, and if there's high volatility, the out of the money options will have a higher delta. So changes in implied volatility will affect out of the money and in the money options much more than at the money options. So you can see that here in this diagram. With higher volatility, it tends to have a flatter delta curve, and a lower volatility has a steeper delta curve. So the delta falls away a lot more quickly in a low volatility stock or a low volatility environment. Let's look at the delta hedge ratio. So delta hedging is a strategy that aims to reduce or hedge the price risk of an options trade. Traders that own a long call option have positive delta, they may choose to hedge some of this price risk by selling stock. The delta of a position tells us the approximate directional exposure in terms of the stock. This is sometimes referred to as position delta. The most common strategy is for a trader to buy or sell stock to offset the delta risk in an option trade. So here you can see an example of a short call option, which has a delta of negative 29, and this trader is buying 29 shares of SPY to completely hedge or neutralize their delta. So they've got zero delta, and what they've done is not impact any of their other Greeks. So gamma, vega, theta all remains the same. By buying those shares, they've just neutralized their delta. Delta can be used as an estimate of probability and is certainly useful to know. A call option with a delta of 0.20 has a roughly 20% chance of expiring in the money. It actually has a roughly 40% chance of being touched at some point during the life of the option. Now, the emphasis is on roughly, as all the variables such as volatility, interest rates, dividends that go into the pricing model also have an impact. If these variables remain constant over the course of the option's life, then yes, this probability would ring true. But those variables are constantly changing, volatility, interest rates in particular. So what is delta dollars? Delta dollars is quite simply the position delta times the underlying price. It's sometimes also referred to as delta notional. We know that delta gives us the share equivalency ratio. So if we own a long call with a 40 delta, it's equivalent to being long 40 shares of the underlying. Now let's assume the stock is trading at 100. So the delta dollars figure would be 40 times 100 equals 4,000. So we're just taking our position delta of 40 times the underlying stock price of 100. That gives us our delta dollars. But why is delta dollars important? Well, it tells us our overall directional exposure in the market or to that particular stock. If a trader has an account size of $50,000 and the delta is 40, that doesn't really tell us much because we don't know what price the stocks are trading at. However, if we look at our delta dollars and the exposure is 200,000, then we know that it's much too high for the account size. That exposure is way bigger than the account size of 50,000. So that's why it's always important to look at delta dollars rather than just position delta. Personally, I like to set a rule that I don't let my delta dollar exposure get above 50% of my account size. More conservative traders might like to start at 25%, whereas more aggressive traders might set it at 100%. So in conclusion, delta is one of the key Greeks in option trading. A solid understanding of delta can help set the foundation of understanding other Greeks like gamma, theta, and vega, which are all essential for advanced option strategies. Delta provides a quick estimate of how much an option price will change with a $1 move in the underlying asset. And by understanding delta dollars, you can better manage your risk of an options portfolio or underlying asset. Thanks for watching. Have a great day. If you've got any questions, please feel free to reach out.